Okay, so let's get on then. The first of the session boxes here is in respect of income tax, and I've chucked in some employee tax issues as well. So let's have a look at what's going on. First thing, of course, the personal allowance and the higher rate threshold. That's the HRT. That's not, by the way, hormone replacement therapy. That is the higher rate threshold. And the news there is rather good. It's a continuing upward trend. If I could push the clock back about 5 years, that would be a downward trend in respect to the higher rate threshold, because the quid pro quo, the something for raising the personal allowance, was squeezing the bandwidth on the basic rate band, but that got a lot of negative publicity. So George Osborne a few years ago said, okay, I'm going to move them both together. If one goes up, the other goes up. So you can see here from the top part of this slide that the government remains committed to that upward trend, and they're raising the personal allowance on their way to 12,500. They're a bit sort of leery about when that might happen. We keep hearing phrases like at the end or by the end of the current parliament, and the higher rate threshold on its way to being 50,000. That's the sort of stuff that pleases Middle England no end, because it means you don't get fiscal drag. It means you get less people being dragged into higher rate tax. So in practice, that means an increase to the PA of over 90% in just over a decade. And you'll remember that the architect of that great upward swing in the personal allowance was, of course, Nick Clegg, the then Deputy Prime Minister. And I'm referring to that, like a lot of people do, as the Nick Clegg trajectory. So that's going up. So the actual budget detail here you can see in the second point. In 2018-19, the personal allowance is going to 11,850. That's up from 11.5, and the higher rate threshold, currently 45,000, is going to go up to 46,350. May I just make the point that that's going to be England, Wales, and Northern Ireland. Scotland has a very slightly different system, and I'll refer to that in just a second. But the big picture is that in 2018-19, a typical taxpayer is going to pay around about 1,000 less tax than they would have done at the beginning of the trajectory, the Nick Clegg trajectory, which would have been in 2010-11. So what's our comment on that? Well, of course, that's got to be a good thing. It's a good plan. It's got to be a good plan to reduce the number of taxpayers at the bottom end of the tax-paying public. What really is quite extraordinary about the income tax take in the UK is, let's think of a number here, it's around about 172 billion this year. It's forecast to be quite a lot higher next year, at about 185 billion. But if you take that number, and that's an astronomical number, it breaks very neatly into three. That is the contribution by basic rate taxpayers, higher rate taxpayers, and additional rate taxpayers. And the extraordinary thing is that it does break very neatly, roughly, into thirds. So basic rate taxpayers pay about a third, higher rate taxpayers pay a third, additional rate taxpayers also pay a third. But the extraordinary statistic in that last bit is that additional rate taxpayers, who pay about a third of that whopping great number, only make 1% of the tax-paying public. So you might want to think about that one. Anyway, at the bottom end, I'm perfectly comfortable with trying to reduce the number of taxpayers. But remember, that doesn't apply to national insurance. The national insurance primary threshold, that is the level at which you start to pay that 12% national insurance, that's 8,164 in the current year. So Nick Clegg's original trajectory is only for income tax. So if you had a salary of 11.5 and you took 8,164 off that and multiply that by 12%, you're talking pretty close to £400 of national insurance, employees' national insurance, that you would still pay, notwithstanding the fact that the personal allowance is going up. So if you wanted to be really sort of equitable about the whole thing, you might argue that the two of them need to move together so you don't get that problem. The last point about Scotland, which I said I'd come back to, is that Scotland, in its devolved powers, has the ability to set the higher rate threshold, but it does not have the ability to set the personal allowance, which is a UK-wide allowance. So in Scotland this year, their higher rate threshold is still 43,000, when ours in England, Wales and Northern Ireland went up to 45,000. So that means that if you're a Scottish taxpayer, you're going to be paying a higher rate on 2,000 more than you would have done had you been in England. So that's a £400 tax differential in there. You can tell whether you're a Scottish taxpayer because you've got a little S on your tax code, which will help distinguish you. Okay, so there you go. I think that's rather good. The marriage allowance, this story goes on and on. It's been around since 2015, and the immediate story is that the Chancellor said he will allow claims on behalf of deceased partners, which sort of sounds a bit morbid, doesn't it? You can actually always go back 4 years on any claim. Remember, if you think you've paid too much tax, this is called a claim for overpaid tax, and you can go back 4 years on all of them except this one, because it's only been around since 2015. So you can have the 15-16 tax year, 16-17, and the current tax year, 17-18. So if you haven't taken advantage of that, then by all means go and do that. So that's the immediate thing, but the backstory in my submission is far more interesting, and that is that the take-up on the marriage allowance has been very low, and only about 50% of eligible couples, who, remember, are married couples and civil partners. You've got to have some kind of formal relationship to be able to apply for this. But the problem is it's not well understood that, first of all, the donee has to be basic rate, and actually, sorry, it's not clear on this slide, but the donor has also got to be either a basic rate or a no taxpayer at all. But the criticality is that if you want to give it to your spouse stroke civil partner, that donee, the person to whom you're giving the gift, has got to be basic rate. You can't do it if they're higher rate or additional rate. And the other thing that really throws people is that the donor can only transfer exactly 10% of the marriage allowance. So in the current year, 10% of 11,500, that is 1,150. So if they've got, say, 500 left over in their personal allowance because they've got a salary, say, of 11,000, they think in their head they can transfer 500. Well, you can't. You can only go, it's binary, 0 or 1,150. And if you give 1,150 as the donor, your own personal allowance revises down, and there's the last point on that slide, the donor may well end up with a small tax liability. So that's the criticality of the information on that one. Now on to a couple of property points. I love property tax. I really do get a lot of queries about that, and we spend a lot of time on our courses talking about property tax, obviously because of the restriction in mortgage interest. But here's one. We talked about the rent-a-room relief, and I've been saying for a long time this is too generous, this cannot last. And interestingly, the Chancellor in the budget yesterday announced, I love this one, a call for evidence on how the rent-a-room relief works. If you recall, it is there to allow people to have lodgers, students, even Airbnbers in a room or rooms in their only or main house. And that means in my simple head, they come in through the same front door as you. You can't have them in the annex or the garage complex to actually get this. But it's been around for a while, and it's gone up in 2016. It had been £4,250 for yonks and donks, and it went up to £7,500. Remember, that's an income threshold. That is not at any price a profits threshold. So it's been around for a long while. People are using it for Airbnb, and of course the problem has been exacerbated by the fact that in 2017, it's been backdated to 2017, even though it's in the Finance Act that's only just got royal assent. That's Finance Act number 2, by the way. And here's the punchline on this, that we've got these two new £1,000 allowances. For one of them's for property, and one of them is for trading, if you like, eBay trading, and the one on property is the one that I'm talking about here. So what's happened is that the government is thinking, too many people taking advantage of this, and by the way, we've just given them these two new £1,000 allowances. So I rather think that the writing's on the wall for that. They may refocus it, they may actually drag it back again, but in the right context, you know, a university city, maybe grandma, her children have long left and fled the nest, and she wants a little bit of extra money, but she doesn't want to move from her house. Having students in your house, which are effectively tax-free income, has got to be a good thing. So I like that one, but I have a faint sense of unease about what might happen to rent-a-room. The other thing, which I think is a sort of a correction process, really realizing the reality of the world has overtaken the legislation. If you are a landlord, an unincorporated landlord, the basic shape is that you should, at least historically, have used, if you want to do mileage claims for travel to your buy-to-let properties, you would have done it on the sort of the old GAP basis and done actual capital allowance claims on vehicles, actual fuel usage. But of course, in 2017-18, what's new in property is that we've got the cash basis, which has become the default basis for unincorporated businesses with turnover not exceeding £150,000 per annum. Oh, by the way, you can opt out if you want simple tick bucks on your tax return to go back to GAP, but that's another story. And I think this bit here, which is all about mileage rates for landlord, is just recognizing what's been happening on the streets for a long time, and that is simply that people borrow the 45/25p a mile rates from ITEPA, that's the Income Tax Earnings and Pensions Act 2003, and it's just regularizing a situation, recognizing that people use the numbers all the time. Why would you not if you've got a simple buy-to-let property business? And this just makes it work a little bit better. So it's just bringing a few things together, tidying up a few loose ends. Okay, now let's go and bash some diesels, because diesels, how amazing is this? They have been, our friends for so long. We've had so many people saying, yes, we love diesels, and governments have been saying we love diesels, and then all of a sudden, the snows have moved on the high mountains, and we've got an avalanche of hatred directed towards diesel cars. And these slides really cover off the employee issues. So let's just think about that for a second. And the headline, I think, says it all. There's going to be more tax on diesel company cars. Now, for a long time, we've had this 3% diesel supplement on diesel cars when you come to work out your cash equivalent. And that has now gone up, or is going up, because going up in April 2018. And that 3% supplement is going up to a 4% supplement. But the 37% overall cap is still going to operate. And remember, just to be clear, this is the second point here, this diesel supplement is used to calculate the cash equivalent on the car, and if necessary, the fuel benefit charge, when an employer provides an employee with a diesel car that's available for private use. And as we can see from the bottom, and as I've already said, that's coming in from April 2018. But it does only apply to diesel cars that aren't quite as clean as perhaps we would like. If they meet the so-called real driving emissions step 2, RDE2, as opposed to R2D2, then you're going to be okay. But if not, then you're going to be hit by these new tax hikes on there. And it's going to have the effect of increasing the level of the taxable benefit. So we're all going to be paying a little bit more tax on that. Incidentally, the diesel supplement doesn't apply to hybrid cars. They get off scot-free. And finally, when on a bit of diesel bashing, there's going to be more road tax too. So this is a supplement to new diesel vehicles from the 1st of April 2018. You'll remember that when you pay vehicle excise duty, road tax if you like, there is a first year rate, and then the standard years that follow after that. And effectively, just to dissuade us from diesels, if you buy a new diesel car on or after the 1st of April 18, then effectively you jump one band upwards in the first year rate, which means you're going to be paying some more tax, road tax. So if you look at the bottom here, for example, somebody purchasing a typical Ford Focus is going to be an extra 20. Well, that's not too much. But look at the bottom bit, a Land Rover Discovery. If that is your taste, then that's going to go up by £400. So that's quite focusing. And remember, it's all about the diesel